Hey gang, Dennis Tubbergen here with another market update. Today is Friday, April 27, 2018, and I have on the screen an article written by John Hussman, PhD. He's president of the Hussman Investment Trust, and it's very interesting that he's got some stock valuations here, which I hadn't seen before, but they're very well done. There's a great quote to start the article: "Measure what is measurable and make measurable what is not so." That's from Galileo. Now, this was published a couple months ago, and he starts the article by saying, "Last week, the U.S. equity market climbed to the steepest valuation level in history based on the valuation measures most highly correlated with actual subsequent S&P 500 10 to 12-year total returns across a century of market cycles." What that means is he's taken these valuation measures and then seen what the stock market has done performance-wise over the next 10 to 12 years. Now, there's three different charts that I'm going to share with you that Mr. Hussman has assembled here. One is the S&P 500 price-revenue ratio. The second is something called a margin-adjusted CAPE, which is a cyclically adjusted price-earnings index. And then there's the market capitalization over GVA, which is the gross value added. So, long story short here, let's just look at the chart. This first chart that I'm showing you here shows the ratio of market capitalization over the gross value added. So the formula is there, but essentially, if you take a look at these ratios, notice how at the market bottom here of 2002 and the market bottom here of 2009, these ratios were under 1. Presently, this ratio is higher than it was just prior to the tech stock bubble bursting. Now, if you take that scale, that chart, as Mr. Hussman did, and put it on an inverted scale, you get the blue line on this chart on the screen. The red line is the average annual nominal total return of the S&P 500 over the subsequent 12-year period. Now, nominal total return is what are the actual numbers, meaning it's not adjusted for inflation. Hussman points out the correlation between these two lines is 93%, and based on the fact that we are here, he is saying that he's expecting the S&P 500 will lose value over the coming 12-year horizon. In other words, stocks will probably be negative over the next 12 years. I use the Dow to Gold ratio as my measure of where I expect stocks to go. I'll show you in a second. I'm expecting a similar outcome. And then if you look at the margin-adjusted CAPE, the cyclically adjusted price earnings index, if you take a look now, this is more extended than it was in 2000 and in 1929. Now, the measure I like to use is the Dow Gold Ratio, and I found a chart here that is showing you that if you take a look at the 118-year average price of gold, a good rule of thumb is if you take the Dow Jones Industrial Average and divide by 10, that's been the average current value of gold. Well, that means at the current Dow Jones level and a reversion of the 118-year average, the current gold price would have to be $27.94. What this chart doesn't talk about are the extremes. See, at the extreme levels, when you take a look at where the market was in 1932, when you take a look at where the market was in 1980 at the low extremes, Dow and the Dow Jones Industrial Average and gold have reached parity. In other words, it would take 1 ounce of gold to buy the Dow. So in 1980, when the Dow was at $850, gold was $850 an ounce. I expect that ultimately that's where we're going to end up. So again, caution is the rule here. It's easy to spot a bubble, I believe, but it's very difficult to predict when that bubble might burst. So take action before it bursts. Protect yourself before it bursts. I'm Dennis Tubbergen. That's today's market update.